Welcome back. You're watching Traders Corner, and joining me as always is Garth McKenzie, founder and editor of Traders Corner. Well, I haven't really been here for a while, have I?
Well, I think we should say welcome back to you. It's nice to have you back.
Thanks, Garth. And it feels like the start of the year for me, but it's clearly been a bit of an interesting couple of months for you and a bit of a grind too, I would imagine.
It has been in the start of this year. It has been. We haven't had a great run so far for the show. We've got 5 trades completed for the year. 4 of those have been losing trades. So we are in the red for the year to date, which doesn't look too good against the market that's been moving up quite nicely. But it is early days. It's only the 5th of March. So we've still got the rest of the year ahead of us.
Yeah,
and
you
things
look
can
chipper
change.
still, not as bruised as you may be feeling inside.
No, not yet. It's still early days.
Okay, well, let's start off with the S&P 500, because I know that's where you wanted to begin the show this evening. And it was, we were just talking off air last night, that being Monday night. US markets were all over the place. They started off really looking quite strong, looked like they were approaching 5-month highs, and then all of a sudden they fell in a heap. And is this what you suspected might happen to the US market?
Well, yes. We've been watching this 2,800 area on the S&P 500 very closely, and that is sort of a zone of resistance that the market does seem to be grappling with at the moment. What I've got here now is a weekly chart, and what I particularly want to focus on here is the fact that obviously that we saw that breakdown last year in the final quarter of the year, and I've spoken about this at length. Now, the market has had a mammoth rally off the lows since December, and you can see now it's pushing up at this 2,800 area. Now, this is a weekly chart. What I want to particularly point out there is the fact that we had this doji candle on the weekly last week. What that means is that you had the open and close at the same level, and usually it indicates a certain level of indecision between buyers and sellers, whereas in the past number of weeks you can see the buyers have just been flattening the sellers every single week consistently. Now we're entering this point where there may be a little bit of equilibrium coming in. And the final candle that we've got here is the current weekly candle. Now, obviously that is only 1 day's worth of trade as things stand now, but we need to watch what happens to this weekly candle now this week. If it prints a weak candle or a red candle,
a reversal, basically.
A reversal, effectively. Then what you could have is what we term an evening star reversal here, where you have the up candle followed by the doji, followed then by a red candle. So I think we need to watch this very, very carefully, and it is notable that this is happening around that 2,800 resistance area.
So that's a weekly chart. What about a daily chart?
Right. So yeah, the daily chart here shows it more clearly. And this basically illustrates this zone of resistance around 2,800 quite clearly. The reason we keep harping on about it is because it's the highs that we saw in October, November, and again in December of last year. And now the market's rallied up and it's basically testing that area once again. Now, every technical analyst out there is drawing this line through 2,800, and that does concern me a little bit, because when everybody sees the same thing and everybody expects it to peak here and for the market to pull back from these levels, often it'll kind of do what you don't expect, and it might go to a point where it creates the most pain for the most people.
In other words, the most pain for the short sellers.
Well, exactly. So right now the pain trade is to be short, and if you are short right now on the S&P 500, you're obviously hoping that it pulls back from this 2,800 area. But as I say, the market has a knack of going to a point where it pushes the most amount of pain onto the most amount of people. So I acknowledge that resistance area, and I do think that at some point we're going to see a pullback, probably towards the 50-day moving average there, which comes in at about 2,650. But right now, I think we do need to just be conscious of the fact that this is a very, very common view that this 2,800 resistance needs to hold, and it might just squeeze the shorts before it actually comes down.
And I suppose, but at the same token, taking a contrarian view might, what are the odds of a contrarian view paying off either at this point in time?
Well, they say often it's the hard trade that pays, which in this case, the hard trade would be to go long here.
Yes.
Right. So let's see how it unfolds for the rest of this week and into next week. I'm not doing anything in terms of a trade on the S&P 500, but I'm just saying what I see here is this major zone of resistance that everybody seems to be fixated on. Let's see whether it actually holds or whether it does shake the tree around that area a little bit.
I mean, if we come back to our own markets, I'm not sure if resistance is the key word there. It's more like stickiness at a certain level. And for me, it has been very interesting, because I feel like I've come back and we're exactly where I left. But within that 5.5 month period, there have been some colossal falls and, as you say, a huge rally. I think the MSCI index is up 11% this year, which is the best start to a year since 1991.
Yeah.
But of course, that would conveniently ignore what happened in the last quarter of last year.
Yeah, well, exactly. I mean, you can see the sort of the final bits there just before you went on leave, where the market was up at 54,000. We're talking about the top 40 now. It went from 54,000, dropped all the way down to 44,000. So it dropped 10,000 points, and now we've rallied from there. We're now sitting up at 50,000 at the moment. You're right about stickiness, and the stickiness comes in at this area around about 50,000 at the moment on our top 40 spot index. Now, what's interesting to note here is that 50,000 area, not only is it sort of a round figure, which the market is often sticky around the round figures, it's also where the 61.8% retracement of that entire sell-off comes into play. And what you can see over the last couple of days is there's been quite a few days where there's been a long tail to the upside on those daily candlestick patterns.
So what does that mean for a layperson?
So what that means is that the market at some point during those days has been trading fairly firm at some stage, but it has been unable to retain those gains. And at the end of the day, it's basically traded down towards the lower half of the trading range. And when you see long tails like that to the upside consistently, it does generally imply that there's selling evident at the higher levels. And as I say, it's around this round figure of 50,000. It does seem as if there's some selling coming in. It is a resistance zone for a number of reasons. Obviously, it's the top of that blue channel that I've drawn in there, and then it's also the 61.8% retracement. And if we were to go all the way back on this chart over the last sort of year or two, you would see that the zone where we've got about 50,000 to 49,000, there's a lot of prior lows in that area as well. So it makes sense to see that the market is struggling a little bit at this area now. The question is, does it now pull back or doesn't it?
Yeah. And I suppose that was the question that you asked of yourself in the last trade, and you expected it to pull back, and unfortunately it seems to have hurt you.
It has, not badly though, but if we look here, so what I did last week for the show was I went short on an ALMI future. Now what we've got here is the chart of the top 40 futures over here over the last couple of months. The ALMI future is essentially like a mini future. It represents R1 per point. So if you've got the future trading at about 50,000 at the moment, R1 per point means that every one contract is giving you exposure to 50,000 rands worth of market exposure.
Yeah.
And it's quite a nice product to trade the top 40, particularly if you're a smaller trader
so
or you're a beginner.
you don't have huge exposure.
Exactly. You don't have to have massive exposure, and it can't go horrendously wrong, hopefully.
Just a little bit wrong.
Just a little bit wrong, which is what it did for us this week. It went just a little bit wrong. So I identified that upward sloping channel that you can see over there quite clearly. And last week, it was after we saw that, what we call a shooting star candle over there. It's also basically a candle with a long tail to the upside. We were sitting in the studio here, and I said, right, this now looks like the short-term top is in. I'm going to go short here. We went short of two ALMI futures at 49,687, and I was then going to use a stop loss above 50,200, which is the highest point of that shooting star candle. Now you can see it flirted there a couple of times. It traded a bit lower, but unfortunately on Friday, in fact not Friday rather, it was Monday, it traded up to 50,000, above the 50,200 area. And I executed a stop loss there at 50,223, which meant that we lost on that trade 1,072 Rand. So it's not a big loss. It's less than 1% of our trading capital.
Yeah. But it's annoying.
It's annoying, but particularly because, as I said at the beginning of the show, we've taken a couple of losses already this year. Admittedly, they've all been small, so it's not a train smash. But it's frustrating to have a string of losses and have a cluster of losses like this. And what's also kind of frustrating is that I still think this might work, but we have to stick with our discipline. We always have done well on this show by sticking to our stop losses and maintaining that discipline. But if I look at that chart now, I still almost feel like it probably is a short at these levels. But rules are rules.
Yes, but you also called it, I think, a revenge trade if you were to short it again, which is almost like I'm right and the market is wrong, or I'm right and the market will eventually see that I'm right.
Well, that's it. And revenge trading is never really a good idea. So if I was to go and put that trade back on here, and it's so tempting to do it because I still believe that it probably is going to turn a bit lower from these levels. But the fact is that it's proven me wrong once. And Look, I think what we need to see is what happens around the 49,500 area. If it starts to trade convincingly below there, then maybe it will signal that we're going lower still. But for the moment, we were stopped out of this trade, and I think to rush back on and put this short trade back in immediately right now would look like I'm revenge trading.
We'll talk about the psychology hopefully at the end of the show, but I know you also want to look at the US dollar index as something to watch this week.
Yes, we're not doing any new trades for the show this week, but what I do think is notable is the US dollar index, and then we're going to translate that into what it does for the rand dollar exchange rate. Now here's the US dollar index. Keep in mind this is an index of the US dollar against a basket of other developed market currencies. So dollar, euro, the other currencies that are there, the pound, the Swiss franc, the yen, the Swedish krona, and the Canadian dollar. So there's 6 currency pairs that make up this with all different weightings. It's heavily skewed towards the dollar-euro pair. Now, from a technical standpoint, what's notable here is that you got this falling wedge pattern that formed through February, and last week it began to break to the upside. And that was after a retracement, a perfect retracement to the 61.8% retracement level and the 50-day moving average there. It's now broken out the top of that falling wedge pattern. So in strict technical terms, this thing is now probably going back up to those prior highs, which is at about 97.25 or 97.5, that sort of area. It is a bit contrarian to what a lot of market analysts have been thinking, that the dollar is going weaker. My question has always been that, you know, US dollar at least is paying you some interest now, whereas none of the other developed market currencies are. So that automatically should probably create some sort of a bid under the dollar. So in order for the dollar to go weaker, it would mean that those other currencies have to go stronger, which I don't see right now. So based on that, you know, it is contrarian, but the charts don't lie. And right now we see that the dollar index does look as if it's breaking higher.
Which is clearly not good to use for the rand.
No, it's not. So here's the rand dollar exchange rate. It looks as if it's formed a bull flag pattern over the last little while here, and it's broken to the upside. If we look at this in strict technical terms, what it also means is that you take that flag pattern and you measure it higher, gives you a target potentially up towards 14 Rand 70 to the dollar.
Okay, ouch.
So, yeah, so if this pattern remains valid, we could possibly see more rand weakness, and that also talks to a stronger dollar as well.
Yeah, okay, we have to leave it there, Garth, and hopefully next week we can discuss how it feels to have a string of losing trades and how to keep your spirits up and your perspective about you. But just to wrap up, what do the portfolios look like? And then I know you've got a course coming up shortly.
Right, yeah, so our South African portfolio is down 1.45% for the year to date. Those are the trades that we've done so far in South Africa this year. And then our offshore portfolio only has this one trade, which is a put option on General Motors, still sitting there, and we're on the wrong side of that currently, minus 1% for the year to date. And then you mentioned the course. I've got a final course in this current series that I'm running, which is in Durban this weekend, the 9th of March. So there is still space available. Anyone that would like to attend, please email me, garth@traderscorner.co.za.
Okay, Garth, we'll have to leave it there. Thanks for joining me, and it's great to be back with you in studio. Garth is, of course, founder and editor of Traders Corner.